The chart looks wrong. Gold is slipping, silver is falling faster, and the comment sections are confused because this isn't how the story was supposed to go. Silver was the underdog metal, the one that runs harder when inflation scares people, the one that retail investors love when things get weird. And yet here we are. Silver just logged one of its 3 worst price crashes in 6 years. Not alone, not in isolation. It's falling with gold. The supposed safe haven is moving like a risk asset. So either the market is broken, or the story we've been told about. Precious metals was always missing a few uncomfortable details. Let's start with why this matters right now. In the last few months, something subtle shifted. Interest rates stayed higher than many expected. The dollar refused to die. Equity markets refused to crash. And suddenly, the same investors, who were hoarding metals for protection, started asking a dangerous question. What exactly are we being protected from? Because markets don't price fear, they price expectations. And expectations have changed faster than headlines. The emotional pitch for silver is easy. It's tangible. It feels real. You can hold it. Unlike stocks, it doesn't depend on earnings calls or CEOs wearing hoodies. Unlike crypto, it doesn't require explaining blockchain to your uncle at weddings. It's supposed to be simple. But the price of silver is not simple, not even close. To understand why silver is falling with gold, you have to understand what silver actually is. And here's the first uncomfortable truth. Silver is not just a precious metal. It's also an industrial commodity, which means it lives 2 lives at the same time. One life is emotional. Investors buy it when they fear inflation, currency collapse, or financial chaos. That's the precious side. The other life is brutally practical. Factories use it in electronics, solar panels, medical equipment, and manufacturing. That's the industrial side. So when the economy looks strong, industrial demand can push silver higher. But when investors are nervous, fear buying can also push silver higher. Sounds like a win-win, except it isn't. Because when both sides weaken at once, silver doesn't fall gently. It drops like a metal anvil through a glass floor. Now step into the mechanics. Gold behaves mostly like a financial asset. Central banks buy it. Large funds hold it as insurance. Its price reacts strongly to real interest rates and currency strength. Silver, on the other hand, is smaller, much smaller. The entire silver market is a fraction of gold's size. That makes it volatile. Every dollar of selling pressure hits harder. And here's where the story turns. When interest rates stay high, bonds suddenly look attractive again. Investors can earn real yields without holding anything shiny. Money flows out of metals, not dramatically at first, just quietly, like air leaking from a tire overnight. Then ETFs begin to see redemptions. Futures traders unwind positions. Hedge funds flip short because momentum breaks. And because silver is thinner than gold, it reacts faster and more violently. This is the uncomfortable math. Silver doesn't just follow gold, it exaggerates gold. If gold sneezes, silver catches pneumonia. But there's another layer most people ignore. The retail myth around silver often assumes scarcity automatically equals rising prices. That because supply is limited, price must go up. But markets don't care about scarcity alone. They care about liquidity. Silver trades heavily in futures markets where leverage is common. When prices begin to fall, leveraged traders receive margin calls. They sell not because they want to, but because they have to. That forced selling creates more downside pressure, which triggers more stops, which leads to more liquidations. A cascade. Fast, mechanical, emotionless. Meanwhile, headlines are still debating inflation fears, while the real driver is simply leverage unwinding behind the scenes. And here's the irony. Many investors buy silver because they distrust financial systems, yet the price of silver is heavily influenced by the most complex parts of those systems: derivatives, institutional positioning, global liquidity flows. It's a metal traded like a tech stock during a volatility spike. Now let's talk about the industrial angle, because this is where hype meets reality. Yes, silver demand from solar energy and electronics has grown over the past decade. Yes, long-term industrial usage looks promising, but markets don't price long-term stories every day. They price short-term expectations. If manufacturing data slows, if global growth forecasts get revised down, if China's industrial demand looks uncertain, silver traders react immediately, even if long-term demand remains strong. This creates a strange contradiction. The very growth narrative that excites investors also makes silver vulnerable to economic slowdowns. Gold doesn't have this problem to the same degree. Gold can rally during recessions. Silver often struggles because factories use less of it. And that leads to the second uncomfortable mechanism. Silver behaves like a hybrid asset, which means it can lose in multiple scenarios at once. High interest rates hurt the precious metal side. Economic slowdown hurts the industrial side. Strong dollar hurts both. 3 pressures, 1 price chart. Now let's zoom into investor psychology. During the last few years, online communities created powerful narratives around silver. The idea that it was undervalued, manipulated, ready for a massive breakout. Those narratives weren't entirely baseless, but markets are brutal teachers. They don't reward belief alone. When prices fail to meet expectations, enthusiasm fades. Retail flows slow, speculative momentum disappears, and a market once driven by conviction becomes driven by disappointment. That shift in emotion doesn't show up on economic charts, but it shows up in price action, and price action shapes perception. Suddenly, analysts start asking whether silver was ever a true safe haven, or just a highly volatile asset wearing a precious metal costume. Now compare hype versus reality. Hype says silver is insurance against chaos. Reality says silver is highly sensitive to liquidity cycles. Hype says industrial demand guarantees long-term growth. Reality says cyclical slowdowns can crush short-term prices. Hype says physical scarcity will force prices higher. Reality says leveraged trading can overwhelm fundamentals for months or years. It's not that the bullish arguments are completely wrong. It's that they ignore the messy mechanics in between. And those mechanics are what cause sudden crashes. There's also a macro twist many investors overlook. Central banks around the world buy gold aggressively. They treat gold as a strategic reserve asset. Silver does not receive the same institutional support. So when large sovereign buyers step into gold during uncertainty, silver doesn't always get the same cushion. Gold has a buyer of last resort. Silver mostly has traders, and traders can change their minds very quickly. Now zoom out further. What does this drop in silver actually signal? It could be a sign that inflation fears are cooling faster than expected. It could reflect confidence that central banks will keep policy tight. It could signal slowing global manufacturing, or simply a broad liquidity squeeze, where investors sell whatever they can. Markets rarely move for one reason. They move when multiple pressures align. And right now those pressures are pointing in the same direction. Higher real yields, a resilient dollar, cooling growth expectations, positioning unwinds, retail enthusiasm fading. Each factor alone might not cause a crash. Together they create momentum. And momentum is the most powerful force in modern markets. Here's where the stakes rise. Because silver's volatility doesn't just affect metal investors, it reflects broader shifts in risk appetite. When an asset known for explosive upside begins to fall sharply, it often means liquidity is tightening somewhere in the system. That tightening can spread into commodities, into emerging markets, into speculative equities. Silver sometimes acts like a warning light, not because it predicts the future, but because it reacts faster than larger markets. And that brings us to the quiet paradox. Investors buy silver hoping for stability during uncertain times, yet its structure makes it one of the most unstable assets when financial conditions shift. It promises protection, but delivers volatility. So where does that leave us now? Silver has suffered one of its worst declines in years. Gold is slipping alongside it, and the narratives around safe havens are being tested in real time. Some investors see this as a buying opportunity. Others see it as confirmation that the macro environment has fundamentally changed. Both sides might be partially right and partially wrong, because markets are not moral stories with heroes and villains. They're systems driven by incentives, liquidity, and expectations. Right now, those expectations are shifting faster than many anticipated. And here's the final uncomfortable question. If precious metals can fall during periods of economic uncertainty, if industrial demand can't fully protect prices, if retail enthusiasm fades when momentum disappears, then what exactly defines a safe haven in a world where liquidity rules everything? Maybe silver's crash isn't just about metals. Maybe it's about a deeper transition in how markets value fear, protection, and risk itself. Or maybe this is just another brutal reminder that narratives feel permanent until price charts quietly prove otherwise. And if silver really is the metal that exaggerates every move, then the real question isn't why it's falling today. The real question is what it might be telling us about tomorrow, before the rest of the market decides to listen.